We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Brett Heath, CEO of Metalla Royalty and Streaming. Brett, thanks for joining me again. How are you?
I'm doing well, Tom. How about yourself?
Excellent. It's great to have you back. And, I'm looking forward to today's conversation with really an insider of the industry. I'm looking forward to digging into your experience, what you're seeing right now, what sentiment is within the industry. But I think a good place to start is to kind of back out and understand how you see the macro setup, really the macro environment for the industry and really the world economy that ends up affecting the industry at this time.
Yeah, thanks, Tom, and thanks again for having me back on. And so, speaking about this macro setup, what we see today is we see ultimately a very significant bid under gold. Obviously, that's the underlying commodity for the entire industry here, and it's been a completely different buyer, and it's been a buyer for very, very sensible reasons. And when you look at what's kind of transpired over the last 5-10 years, we've seen this kind of shift in thinking kind of globally, kind of around the risk profile of holding either US assets or the US dollar. And that kind of started when Biden kind of weaponized the US dollar with the SWIFT system and all the seizing of Russian assets and so forth that went on during the Biden administration. And then Trump kind of picked that up right off with all of this tariff. Basically using tariffs as a means to negotiate. But while he's doing that, what he's doing is he's really disrupting the confidence and kind of the comfort level of all of these other emerging market economies and so forth around the world, where they're kind of thinking like, well, maybe we shouldn't be holding 80, or we shouldn't be holding 80%, 60%, whatever the percentage is of our foreign reserves in US dollars. What if a tweet goes out from Trump saying that, all of a sudden, we've got some big 100% tariff or whatever the percentage is. And so the sensible thing for all of these governments to do around the world is to slowly reduce that risk. And when you look at kind of the average, you look at all the emerging market countries out there. When you look at kind of the average, the U.S. Treasuries that basically, as a percentage of their foreign reserves, like almost all of them are over 50%. And all of these emerging markets have been sending us goods. We've been sending them back paper, and that has grown very, very significantly. When you look at foreign established governments, then it's not quite as high. But what we're seeing those different governments around the world, they're slowly rotating the treasuries into gold. It's been a very, very strong bid, and we see it continuing, right? Because these countries have to significantly reduce their exposure to this asset class. And I think the perception globally for this asset class is now changed. Like I think what was perceived to be one of the safest assets in the world is all of a sudden, when they're looking at this asset class, looking at it from a much higher kind of risk profile, and that's kind of changing things. And changing things that we haven't seen for quite some time. So when you look at the backdrop of the gold industry, we're seeing gold go higher. You're getting these violent kind of, we just saw a trade deal with China announced, and gold was down like $100+ that day. And so what you're going to see is these kind of violent pullbacks, but they're going to be met with very, very strong bids. And that's going to kind of continue to kind of climb that wall of worry of that bull market. And I think that when you look at kind of where the market is generally and how under-owned gold is as an asset class still today, we see it significantly higher in the future. It doesn't mean we can't see consolidation we saw gold move from 2,000 up to 3,500. We could easily see reasonable consolidation or kind of a sideways move for 6-12 months. But over the longer term, like we see gold with a very strong bid under it from a macro standpoint, and we see gold much, much higher.
Mm-hmm. So you mentioned central banks driving lots of this buying. Is there a significant difference between, let's say, the Eastern central banks and Western central banks in terms of appetite here?
Well, I think what it comes down to is where if you look around the world and you look at the concentration of kind of from a percentage kind of point of view on how much foreign reserves are held in U.S. Treasuries, and then you look at all those central banks, those are the ones that are at most risk. And in most of those, like as I noted, are emerging market type of economies, which includes China, Brazil, India, a lot of other parts of Asia as well, are kind of significantly overweight this asset class in regards to their foreign reserves. And so, we see that kind of continuing to kind of rebalance, if you will.
So how do you see that, basically that trickle down effect? Who starts buying after the central banks start buying? And does that appetite automatically come down and trickle down from the central banks?
Well, I think it does. When you look at kind of the any type of the macro indicators, like if you look at kind of the price to earning ratios over long periods of time, when you look at kind of public concentration within stocks, for example, they're at extreme levels, and so the expectation is that you see those capital flows rotate. We're seeing them rotate already. When you look at kind of the relative performance within the gold equities versus the S&P and other types of sectors, you're seeing this rotation on a relative basis. When you look at the ratios already, like it's as clear as day that the capital has been shifting. You can't quite kind of see it yet in kind of looking at it on an individual basis, but when you want to kind of get a better sense of where capital is moving, you look at the kind of relative performance, like the ratio type of performance between these different sectors. And so we see that already in motion in regards to specifically on the bullion side and our performance, but it has not quite happened yet. Kind of generally, again, gold as an asset class is the most under-owned asset, or kind of on a percentage basis, it's been kind of it makes up the smallest percent that it has any time in the last 40 years.
So, Brett, what timeline are you looking at? Considering how much volatility there has been, what timeline do you really try to understand the direction of these markets with at this point?
Well, in regards to the gold sector, I think that these businesses are going to start to become very, very profitable. I think that they're going to continue to, even as the prices are right, the equity prices are rising on the backdrop of the gold and the expanding margin. Like I think these gold. The gold sector as a whole is going to become even more attractive. And so, at some point, it's likely that I think the rest of the market looks at this just from a business perspective. Forget about gold, forget about mining, forget about any of this, but just understanding like, look, this is a business. These are the fundamentals of this business. And it is attractive enough for me to go in and invest in this type of business. I think that is what it's going to take for kind of the larger kind of reverse of capital flows to happen and kind of the increase And it's impossible to know exactly when that is going to happen. But when you look at kind of how on a number of different bases, on a valuation type of metrics, or when you look at kind of dividends and so forth, the gold sector is already kind of in the top quartile or even leading a lot of these categories, versus many other sectors today.
Well, Brett, despite those excellent numbers that gold has been, and these gold companies have been throwing off in regards to profits and all of that, how do we see the flows developing, let's say, within the GDX and GDXJ? You shared with me some stats before we started recording here today that doesn't reflect a shift in momentum yet.
Yeah, that's right. And not even a shift in momentum, but actually on a negative basically flow. When I looked at the GDXJ today, and I looked back 12 months, there has been only 3 weeks in the last year of net inflows, and in fact, 100% of the weeks from January 1st of this year, both on the GDXJ and the GDX, have been all outflows. When you look at kind of what the net outflows have been from the GDX J in the last 12 months, it's been about 1.6 billion, which represents kind of mid-teen% kind of outflows. And on the GDXJ, kind of similarly, about 3.6 billion of net outflows in the last 12 months. And this is on the backdrop of gold moving to all-time highs. I mean, 3,500, north of 3,000. These numbers were, people could barely speculate on a $3,000 gold price, 18 months ago. So, seeing these numbers, seeing kind of the net outflows, it clearly says, like, look, there is not only no speculation in these markets at all, which I think explains kind of when you look at the gold stocks and the value of kind of where these stocks are trading at relative to gold. They're about the cheapest that they've been, at any time in the last 30, 40 years.
Mm-hmm. Brett, I've had a couple guests explain to me that, as gold obviously reacts to the uncertainty within the investing world, that the major catalyst of the turning point typically within the equities starts to be the Fed going back to cutting dramatically and or QE, resuming QE. So how do you see the Fed's role in precipitating this next bull market within the equities? Do you see the Fed stepping back in here in a meaningful way over the next 12 months?
That's a tough question today to understand. I feel like there's quite a bit of data on both sides of the equation when you're looking. What we're kind of paying attention to is when you look at kind of the yield curve, and the yield curve was heavily inverted, and now it's basically back to stabilization. And at every single point in time, going back to, I believe, the early 80s, as the yield curve has kind of stabilized from an inversion, the economy's gone into a recession. And when the economy goes into a recession, at least going back kind of to the early 2000s, the Fed is always there to kind of step in. Now, we don't get recessions anymore because the Fed has been involved so much within the economy and so forth. What we get is panics. And so we had a little bit of a brief panic not too long ago. We saw stocks fall and then, basically reversed. And a lot of that was kind of, I guess, kind of on the back of some Trump uncertainty in regards to policies and so forth. But when these things tend to happen, they're going to happen anyway. There's always going to be something that kind of makes it happen and is the kind of catalyst for it. But for when you look at these markets and you look at kind of how they function, there's always a catalyst, but it's like it could be any catalyst when the market's ready to have one of these big volatile swings. They typically do, and so we're kind of seeing that right now. I think that if you just look at what has happened, I think the Fed is going to kind of feel compelled during any kind of violent panic to step in and stop the bleeding. That being said, when you look at the gold price, I think that, and you look at all the forward-looking indicators, I think we will see inflation pick up, and so it's going to be difficult for the Fed to kind of heavily cut as they've done in the past on the backdrop of rising, inflation and I think probably more of a stagflation type of environment where you've got a recession, you got prices rising at the same time you've got a recession and a declining economy.
Brett, what do you think the biggest drivers of re-accelerating inflation are at this time? Is it, more costs associated with the tariffs? Like, where do you think the biggest drivers come from?
Well, the tariffs are a tax ultimately, like that will drive prices higher. But also there's an element of kind of what's happening around the world where we've had this kind of globalization for so long, and now it's kind of a reverse trend. Everything's kind of becoming more nationalized. And so all of the different normal supply chains and labor costs and all these other things are going to have to change. You can kind of see like I've seen some numbers of like what iPhones would cost if they were built in the US and so forth. And they're significantly higher than what it would be if they're, the way that they're built in China. Not to mention the labor force needs to be retrained and so forth. Like it's quite, I think there's not going to be kind of one kind of factor in regards to that happening, but I think all of these things happening at the same time, and that all of these things happening on the backdrop of a declining dollar, I think is going to spur a lot of that inflation. And I think again, like that's another reason, like on the backdrop of all of the geopolitical uncertainty, all of the fiscal kind of the balance sheets of governments globally with significant amounts of debt, and so forth, and even seeing kind of interest on that debt, with the US, surpassing $1 trillion a year. So, these are becoming very, very significant numbers. If you do get a recession, typically it's going to be met with more liquidity, and then the GDP is going to decrease, which is going to significantly increase the budget deficits. And so it's kind of a compounding effect. And when you look at kind of where that is kind of 5 years, 10 years out, those expectations, you look at kind of the uncertainty geopolitically, I think that gold is really becoming kind of this centralized asset class without liability that not only governments are moving towards. And so that's the trend. When you would think that we would be in the latter stages of the bull market, but I think it's still very, very early. And I think it is on that basis, given kind of when you look at kind of the speculation, the speculative nature of kind of what's going on within the mining companies and so forth is just basically like there's very, very little.
Brett, you mentioned the amount of debt that the US has, and especially the amount of debt that needs to be refinanced here coming into the next 2 years. I think it's something like $7 trillion or something like that, that needs to be basically refinanced from, I believe it's something like 50 basis points up to 4.5%, something like that, or 450 basis points. So do you see that as a possibility to start driving the Fed's behavior of maybe where interest rates are headed over the next 2 years, considering that refinancing cost?
Well, I think generally it's the I think the uncertainty that the Fed understands that ultimately it's going to be a very, very big problem. And when you kind of expand that over between 2024 and 2027, and some of that has already been refinanced, which has been driving the interest cost kind of over $1 trillion a year. But between 2024 and 2027, you've got about 17 trillion that have to be refinanced in those three, on top of whatever else is issued based on those budget deficits. So when you go out another 1, 2, 3 years, kind of you go out to 2027, 2028, if interest rates don't come down, which, again, like I think it's going to be, I think that during a panic, the Fed will try to step in and have, some form of kind of liquidity injection on however, whatever they'll call it, something else and so forth. But it's going to be difficult. It's going to be a lot more difficult for them to do that than it has in the past. And those budget deficits, yeah, those are real. When you look at kind of what the interest expense will be if interest rates stay at 4.5% over the next couple of years, and what the interest cost would be, you're getting to kind of points where, I think a lot of people around the world, see it as a breaking point. And again, like I see this on the backdrop of gold continuing to move higher through that period of time.
So Brent, as a real industry insider, has the higher gold price, $31, $32, $3,300 gold price here, and seemingly very sustained over 2025 so far, has this changed sentiment at all within the industry from the companies that are actually operating within that gold price?
So when you look at the industry, there has never been more kind of M&A chatter across the entire industry. And I think that's been driven by really a significant divergence on how the market is valuing specific types of assets within the industry. And when you look at kind of how production is being valued today, it's being valued, I think, fairly well. You look at some of the big operators. Now, I would say it's being selectively valued very well, because when you look at the actual equities that are performing in this market, they're the big producers, like any that is more heavily weighted towards production within their portfolio of assets, and we almost are seeing it across the board on the companies that are very consistent in controlling their costs. So the big operators that have shown kind of very solid discipline on controlling costs over the years are performing very, very well. The big royalty companies have been performing very, very well. Obviously, their costs are fixed. And then you see this divergence with kind of anything in development, any type of development projects trading at very, very low valuations, and call it relative to gold, probably the lowest valuations that we've kind of ever seen. And these production companies are throwing off a ton of cash. So, they're looking around. It's almost, it's not impossible, but it's very, very difficult for these companies, given the lack of investment into exploration and kind of, investing in their own pipeline, to be able to maintain that production profile. These big mining companies that are producing 1 million, 2 million, 3 million ounces a year. I mean, if you think about that, like, how do you replace that? How many different operations, like even a big mine, which would do, 200,000+ ounces, like, what does it require? Like, how many of those deposits are actually out there around the world, are in good jurisdictions? And given the lack of investment in the industry on the exploration side over the last 10, 20 years, this is very, very limited. So what does that mean? It means that in order for these companies to maintain their production profile that are kicking off all this cash, they have to acquire basically these assets. And so they're looking around, I think right now, being flushed with cash and saying like, look, we can bring these assets now in production. I think we're going to see a lot more M&A transactions happen because of that. And I think kind of what you'll see, and I think that, what today is the best opportunity in the gold market as a whole is high quality gold in the ground. And I think high quality gold in the ground within call it the gold sector is going to be the best performing asset over the next 5 years by a wide margin.
Brett, this seems like almost an inevitability at this point that the gold equities are going to start attracting capital because of the free cash flow and because of the positivity within the sector. What could still go wrong for the industry? What are maybe some of the big hurdles to reattracting capital, and what could divert or derail the rotation of capital back into the sector?
Well, I would say that the most sensitive part of the equation for investors is costs. So again, companies that have done a very good job of managing their all-in sustaining costs on their assets have done very, very well and have been rewarded very, very well within their share price.
Mhm.
And when you look at any big mining company that even has like the slightest miss in regards to kind of their costs or their expected costs, the stocks are getting absolutely crushed. And so that is a very, very sensitive part. Right now, given kind of energy is fairly under control, like we don't see any kind of very significant, increases generally in the costs for a lot of the equities and a lot of the mining companies. So we think that relatively like that should be fairly under control. But at some point, if those costs go up, investors are very, very sensitive to it. And so I think that could be, a problem, obviously, with the inflation backdrop and where gold is.
But wouldn't it be possible to see the relative growth in the gold price along with that if we're seeing more inflation as well?
Yeah, I think so. But I mean, investors typically are after that margin, right? When a investor comes in and buys a gold mining company versus a royalty company, they're typically, their answer is, well, the gold mining company has more leverage.
Mhm.
When I look back at cost generally over a very, very long period of time, it's pretty consistent. There's different times where you see a big move in the gold price, the margin expands quite a bit, but then that always kind of catches back up. And I think nominally we could be sitting with a very, very high, like a significant and much larger margin. But I think on a percentage basis, over time, that'll probably revert back to the mean it always has with the gold equities. But I think kind of nominally, like these businesses should look really well. And the way to kind of manage that again, like you can look at the royalty companies, which have much more kind of fixed costs generally than the mining equities do, and I think in fact have more leverage.
I've heard you say before that mergers and acquisitions within the industry could get quite chaotic. What does that mean, and what is that a sign of? Is that just competition within the industry because of the producers having so much money to go after increasing their resource base?
Well, it's driven off the scarcity of high quality assets. That's the problem, is that there are not enough large high quality assets. When you look at kind of what's transpired over the last 5 to 10 years, you've seen a lot of very large mining companies merge, and they've merged out of necessity because they had to merge to kind of be able to kind of maintain just maintain their production profile, much less show a little bit of growth. And so what I think that could be chaotic is, given the lack of high quality scalable assets that are out there today, I think they're going to be very competitive. I think they're going to be very competitive, and they're going to be competitive because if one mining company signs a deal to do an M&A transaction, and the rest of the sector is looking around, and there's only two or three of these types of assets that are available at this scale in a good jurisdiction and so forth, they're going to think about they're going to think about potentially kind of competing and making things a bit more chaotic, if you will, within the markets as there's less and less and less of these higher quality assets.
Mm-hmm. Do you think it's possible that the way that gold mining companies are valued has changed in an appreciable manner since, let's say, the last real bull market of 2008 into 2012?
Oh, it's completely different. In 2000, in the bull market that was back like in 2009, 10, 11, 12, there was a healthy amount of speculation. You saw, in fact, a lot of the development and exploration assets trade at valuations that were relative or even higher sometimes than some of the producers. If it was a really good, solid kind of quality assets and so forth. Where today you really haven't seen any of that yet, and again, like, the market is only kind of giving value, I think, to production today, and so there's been this huge divergence. But again, I think that is an opportunity when you look at again, big kind of investors coming into the sector. It was just maybe a few weeks ago, John Paulson, who was famous for shorting a lot of the mortgage-backed securities and so forth during the financial crisis, came in and acquired a significant piece of the Donlin Gold project, which was from Barrick, and in fact wrote, I don't know if you wrote the entire amount, but it was something upwards of, I think, $800 million to buy high quality gold in the ground. And I think ultimately Barrick surfaced about $1 billion of value for this 50%. I think Paulson owns the lion's share of that, and there was a handful of other U.S. institutions that came in and basically, along with Nova Gold, put up the majority of the capital to buy that whole high quality gold in the ground. And so I think you're going to see more of that. Like, I think you're going to see more of that. We saw another example of a royalty company announced to be taken over for a royalty in Nevada at a very healthy valuation as well. And so again, like, I think that's the trend. And so as an investor kind of looking around, there are a lot of opportunities. It's not just one company. There are a lot of opportunities given the divergence and given kind of the type of investor that has come into this market with a backdrop of $3,000+ gold, really focusing on kind of the actual fundamental businesses and the cash flows and so forth. You have this whole part of the market that has kind of been left at valuations relative to gold at basically lows, again, that we haven't seen, or have only seen briefly a handful of times in the last 20, 30 years. So, I think that as that scarcity, again, I don't think it's going to be all gold in the ground, but I think the higher quality, the same thing is going to happen that we've seen on the production side, where it hasn't been all of the producers that have done very well, but you've got 25, 30% of the producers that consistently that are in that lowest quartile of producer cash costs and that have shown consistent track record of controlling those costs, those companies have done very, very well. And I think when you look at it kind of on the flip side on these development assets, I think it's the higher quality, good jurisdiction, better grades and scale. I think scale is a very, very significant part of it because all the big gold mining companies, they have merged over the years. They're getting bigger and bigger and bigger and bigger. 4 years ago, a 150,000 ounce a year type of project for a company like Agnico Eagle was kind of right down the middle. And in fact, like we've had royalties on projects that Agnico was looking at developing. There were 150,000 ounces, and then as they merged and got bigger and bigger and bigger over the years, all of a sudden those projects become a little bit less material for them. And so they'll probably ultimately, if it's a good asset, it'll get sold off to another company and they'll develop it. But for these bigger mining companies, they're needing bigger and bigger and bigger projects. And the problem is there's fewer and fewer of those around.
Mm-hmm. Brett, as gold, really accelerates here and becomes a lot more expensive, do you see silver catching up or having a proportionate rise as well? We've seen the extremes in the gold to silver ratio. What are your thoughts around silver going forward here?
Yeah, so I mean, we look at the ratio as well, and the ratio it's around 100 ounces of silver to 1 ounce of gold right now. And you go back over the last 100 years, that's basically happened about 4 times. So it's very, very rare to ever see the ratio go over 100 to 1. And in fact, when you go back in time and you look at that ratio, typically you've seen that ratio happen in a period of time where metals are going down or there's big panics like 2008 or in 2020 where silver gets sold off significantly more than gold does, because in a panic type of environment, gold typically does a little bit better because that's the safe haven asset, and then silver gets sold off. So we're seeing again the ratio at relative to kind of where it's been, at extremes. Silver has always been a speculative metal. So it makes actually a lot of sense when you look at kind of where how the market is valuing equities and silver. I would put silver in a bucket that kind of sits right with, call it the lower half of the mining sector in regards to kind of some of the call it smaller mid-tier and larger kind of junior producers from kind of a speculative risk profile. And when you see silver perform, like if you go back in time, when silver went from back in 2008 to 2011, where you saw silver go from $25 an ounce up to $50 an ounce, well, you saw the equities perform extremely well right alongside silver. And so again, it kind of brings you back to, well, who are the ultimate buyers and what are they buying it for? And so you don't have any of that speculative nature within the mining sector, and with that, you don't have that speculative nature with silver. And so when you see silver go, you're going to see a lot of these mining stocks go right with it. And I think there'll need to be that shift for that to happen, which we see kind of that starting to happen, but it's pretty far from it being fully in motion today.
Mm-hmm. Excellent, Brett. Well, I appreciate your insights and your expertise from within the industry. Just in wrapping up here, is there anything that you'd like to leave our listeners to think about or to pay attention to before we do?
Yeah, I think what you want to look for, again, in these markets, in kind of a change is that ratio of the silver to gold violently reversing. And when you see that violently reverse, again, you're going to see probably a significant rise in silver. You're going to see those fund flows, and watch the fund flows. There's ways to monitor these fund flows, and when you see those reverse heavily, kind of consecutive week after week after week, I think that's going to be a sign where it's going to be you'll notice kind of a move in the equity price, but it'll more likely be sustained when you see that trend change.
Mm-hmm. Excellent. So for those that would like to hear more from Brett or check out Metalla, that's all available at metallaroyalty.com. And always appreciate your time and checking in with you, Brett.
All right. Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.